Stop everything you're doing right now. It's Sunday evening, January 18th, 2026, and in the last 48 hours, something happened that's going to fundamentally change the silver market forever, and almost nobody understands what just occurred. While you were enjoying your weekend, while the mainstream media was laughing and making jokes about President Trump trying to buy Greenland again, the entire logistical infrastructure of the global silver market was quietly destroyed. Not damaged, not stressed, destroyed. And tomorrow morning, Monday, January 19th, 2026, when markets open in Asia, London, and New York, we're going to see the consequences play out in real time. The chaos, the confusion, the price dislocations that are coming in the next 24 hours will be unlike anything we've seen in modern commodity markets. And if you don't understand what's happening and why, you're going to make decisions based on incomplete information that could cost you dearly. Let me be very direct. Tomorrow is not going to be a normal trading day. The silver market that closes Friday and the silver market that opens Monday are two completely different animals operating under completely different rules. And the catalyst for this transformation isn't some obscure financial regulation or a change in Fed policy. It's a tweet. A single tweet from President Trump about buying Greenland that contains one sentence, buried in the middle of a geopolitical negotiation that effectively severed the artery connecting the two largest silver markets on Earth. Here's what happened and why it matters more than anything else you'll hear about silver this week. On Saturday afternoon Eastern Time, President Trump announced via social media that he's renewing his offer to purchase Greenland from Denmark. The media immediately went into circus mode, talking heads laughing, Danish politicians expressing outrage, late-night comedians writing jokes, standard political theater. But hidden in that announcement was a single line that made every risk manager at every major bullion bank in London and New York stop breathing for a moment. President Trump announced a 10% tariff on all imports from 8 European nations, including the United Kingdom, effective February 1st, 2026. And if a deal for Greenland isn't reached by June 1st, that tariff increases to 25%. To 99% of people, this sounds like typical trade war posturing, political leverage, negotiating tactics. But to the people who actually understand how the global silver market functions at a mechanical level, this is a nuclear weapon detonating in the middle of the Atlantic Ocean. Let me explain why, because this is absolutely critical. The global silver market operates on a concept called fungibility. It depends on the assumption that a 1,000-ounce bar of silver sitting in a vault in London is functionally identical to a 1,000-ounce bar sitting in a vault in New York. More importantly, it depends on the ability to move that bar back and forth between London and New York cheaply, easily, and without friction. This constant flow of physical metal across the Atlantic is not a nice-to-have feature. It's the foundational pillar that allows the entire paper-silver market to exist. Here's how the game works, and I'm going to use simple language because this needs to be crystal clear. When the price of silver rises in New York due to high delivery demand on COMEX, the bullion banks take physical silver out of their vaults in London, specifically from the London Bullion Market Association LBMA vaults, and they literally fly it across the Atlantic to New York. They flood the COMEX warehouses with physical metal, which relieves delivery pressure and pushes the price back down. Problem solved. Conversely, when London's physical inventories run low, which has been happening with increasing frequency due to massive demand from India and China, the banks take silver out of COMEX warehouses in New York and ship it to London to refill the shelves. This back and forth, this constant shuffling of physical metal between the world's two largest silver trading hubs is what we call the whack-a-mole game. Wherever the pressure builds, wherever the price starts spiking due to physical shortage, the banks can alleviate it by moving metal from the other location. This system allows the banks to create the illusion of abundant supply. It allows them to suppress price spikes. It allows the paper market, the futures contracts, the unallocated accounts, the ETFs to function smoothly because there's always a relief valve. Physical pressure building in New York, ship metal from London, physical shortage developing in London, ship metal from New York. The global silver market is really just two pools connected by a pipe, and as long as metal can flow freely through that pipe, the system stays balanced. But what happens when you put a 10% tariff wall directly in the middle of that pipe? What happens when moving silver from New York to London and back again suddenly costs 10% of the metal's value? I'll tell you exactly what happens. The pipe breaks, the system fragments, and the two pools that were previously connected become isolated islands operating under completely different supply-demand dynamics. Here's the brutal mathematics that every risk manager at JP Morgan, HSBC, Citigroup, and Scotiabank is calculating right now on a Sunday evening. Let's say you're a bullion bank. You see that London is desperate for physical silver. Vaults are running low. Delivery demands are piling up. The price is starting to spike. You want to ship 1 million ounces from your COMEX vault in New York to your LBMA vault in London to stabilize the situation. Seems straightforward, right? Shipping the silver from New York to London is easy. There's no export tariff leaving the United States. You load the metal onto a cargo plane, it flies to London, it clears customs, and within 48 hours, you've restocked your London vault. Crisis averted. But now let's think 2 months ahead. What happens when COMEX starts running dry and you need to bring that silver back to New York to settle delivery obligations on futures contracts? Now you have a massive problem. That silver is coming from the United Kingdom. Under Trump's new tariff policy, it's subject to a 10% import tax when it enters the United States. If silver is trading at $90 per ounce, you now have to pay the US government $9 per ounce just to bring your own metal back into the country. On 1 million ounces, that's $9 million in pure tariff costs. That $9 million comes directly out of your profit margin, and in the razor-thin world of commodity banking, where profits are measured in basis points, a 10% hit isn't just a loss, it's complete obliteration. So the risk manager looks at the spreadsheet and realizes, if we send this silver to London, we effectively lose 10% of its value permanently because we can't afford to bring it back. The metal becomes trapped. It's a one-way valve. Silver can enter the United States from non-tariffed countries, but silver cannot leave for London because once it leaves US soil, it costs 110% to retrieve it. This completely destroys the whack-a-mole game. The banks can no longer smooth out volatility by shuffling metal between markets. If London spikes to $120 while New York stays at $90, the banks cannot step in to close that $30 gap by shipping metal from New York because the tariff wall makes it economically impossible. The arbitrage that should bring prices together across global markets has been eliminated by government policy. And here's where it gets even more interesting. This is what I call the Roach Motel Effect, and it's going to have profound implications. You know the old pest control slogan, roaches check in, but they don't check out? Well, President Trump just turned the United States bullion market into a roach motel for silver. Metal checks into the US, but it doesn't check out. Any silver that's currently sitting in COMEX warehouses or dealer vaults in the United States is now effectively trapped here. Banks won't ship it to London because they can't afford the 10% penalty to bring it back. This means all that metal, hundreds of millions of ounces, stays on US soil permanently. Now, the mainstream media is going to completely miss the significance of this because they're focused on the headline about Greenland. They think this is about ego, about Trump wanting to make a splashy real estate deal. But look at the actual effect of the policy, not the stated intention. By trapping silver inside US borders, Trump has accidentally, or perhaps deliberately, created a domestic strategic reserve of critical minerals without having to buy a single ounce. We know from industry reports that the US Mint has been struggling with silver supply for eagle production. We know that American manufacturers like Tesla, Apple, and defense contractors need silver for batteries, semiconductors, and weapons systems. And we know that until now, a significant portion of US silver inventories could be shipped overseas if foreign markets offered better prices. Well, not anymore. That silver is staying here. It's staying available for American industry, American defense, and American coinage. It's America First applied to the periodic table. Meanwhile, this policy forces Europe, and specifically London, to fend for themselves. It tells the LBMA, you're on your own. You can't raid our vaults to bail out your exchange anymore. And this is happening at literally the worst possible moment for London, because London is already in crisis. Let me explain the situation the LBMA is facing right now. For the last 3 years, there's been a relentless exodus of physical silver from London to Asia. India and China have been buying silver in quantities that would have seemed impossible 5 years ago. Every month, tens of millions of ounces flow out of LBMA vaults, get loaded onto container ships, and sail east to Mumbai, Shanghai, and Dubai. London's inventory has been bleeding steadily, and the publicly reported numbers from the LBMA show that available silver, meaning metal that's not already pledged to ETFs like SLV, is at critically low levels. London has been surviving on a lifeline, the ability to import metal from the Americas when inventories get tight. When LBMA vaults run dry, they call up the Bullion banks in New York and say, we need 5 million ounces ASAP. And the banks would execute what's called a location swap, trading ownership of bars in New York for ownership of bars in London, or they'd physically ship the metal. Either way, New York metal would flow to London and keep the system functioning. But yesterday, Trump cut that lifeline. He made the transaction financially toxic. No rational bank is going to ship silver from New York to London if they have to pay 10% to bring it back later. So London is now an island, literally and financially. They're cut off from COMEX supply, they're cut off from Mexican and South American production that routes through US refiners, and they're still facing insatiable demand from the East. This creates what I can only describe as a siege scenario. When trading opens in London on Monday morning, the professionals there are going to realize they're in a trapped position. They've sold more silver than they have access to, and the backup supply from New York that they were counting on is not coming. This is the setup for a localized default, a situation where London physically cannot deliver on all its obligations. And here's where the market structure gets really dangerous. Most major bullion banks run what's called a global book. They manage their silver positions across multiple markets simultaneously. A bank might be long silver in London, meaning they owe silver to clients, and short silver in New York, meaning clients owe them silver. Under normal circumstances, these positions hedge each other. If the price moves up, they lose money on the long position but make money on the short position, and vice versa. Net exposure is minimal. But what happens when London and New York start trading at completely different prices because metal can't flow between them? The hedge breaks. If London silver spikes to $110 while New York stays at $90, the bank is suddenly losing massive amounts of money on the $20 spread. Their carefully balanced global book becomes a catastrophic loss generator. This forces them to frantically close positions, buying back shorts in New York and selling longs in London, which creates buying pressure in both markets and accelerates the price dislocation. Now let's talk about Friday's 4.2 million ounce withdrawal from COMEX that we discussed in previous analysis. On Friday, someone, we don't know who, withdrew 4.2 million ounces of physical silver from COMEX warehouses. That's an enormous amount. At the time, we speculated that metal was being shipped overseas to meet delivery obligations in London or Asia, but with Sunday's tariff announcement, that analysis needs to be completely revised. That 4.2 million ounces is almost certainly now stuck in the United States. It's probably sitting in a warehouse near JFK Airport or in a security facility in New York, wrapped in plastic with nowhere to go. The owner of that metal is facing a decision. Ship it to London and accept that you can never bring it back without paying 10% penalty, or keep it in the US and sell it to domestic buyers. Given the uncertainty, given the risk, the rational choice is obvious. Keep it here. This has two major implications. First, it means the physical squeeze in the United States might ease slightly in the very short term. That 4.2 million ounces that was supposed to leave the country is now available to domestic buyers, mints, manufacturers, dealers. But second, and far more important, it means the physical squeeze in London is about to go nuclear. London was counting on metal from New York to arrive and replenish their vaults. That metal is not coming. The cavalry has been turned back at the border. So what happens Monday morning when Asian markets open, followed by London, followed by New York? I'm going to walk you through the most likely scenario, and I want you to understand this is not wild speculation. This is based on how commodity markets have historically responded when logistics chains break and arbitrage becomes impossible. Asian session opens Sunday night U.S. time. Shanghai and Singapore silver markets will likely gap higher immediately as traders realize the LBMA supply situation has deteriorated dramatically. Physical silver in China, which was already trading at a $15-20 premium over COMEX prices, could spike to $30-40 premiums as buyers anticipate that London won't be able to source metal for Asian shipments. We could see physical transactions in Shanghai at $120-130 per ounce, while COMEX futures are still showing $90. London opens Monday morning. This is where it gets truly chaotic. London traders arrive at their desks and see that Asian physical prices have exploded overnight. They see the Trump tariff news. They start running calculations on their inventory positions and their exposure to Asian delivery commitments, and they realize they're in trouble. I would expect to see London silver prices gap up significantly at the open, potentially 10-15 higher than Friday's close, as the market begins to price in the logistical crisis. But here's where it gets really interesting. We might see the LBMA implement emergency measures. They might announce extended delivery timeframes, claiming unprecedented market conditions require additional processing time. They might encourage or even incentivize cash settlement instead of physical delivery. These would be desperate moves to buy time while they figure out how to source metal without access to U.S. inventories. New York opens Monday morning. COMEX futures will open in a state of confusion. The algorithm-driven traders who dominate the futures market don't know how to price a 10% tariff on transatlantic silver flows. Their models don't have a variable for trade war eliminates arbitrage, so we could see wild volatility, big swings in both directions as different trading systems try to interpret the new reality. Some traders will see trapped U.S. inventory as bearish. If metal can't leave, doesn't that mean oversupply in the U.S.? But the more sophisticated players will realize that trapped U.S. inventory is massively bullish because it means COMEX can't be used to bail out London, which means London defaults faster, which means the entire paper-silver market's credibility collapses, which means everyone rushes to get physical before the system breaks entirely. My expectation is that after initial volatility, COMEX silver will trend higher throughout Monday as the implications become clear. We could easily see $95-100 by Monday's close, and that's actually conservative if panic buying develops. Now let's talk about the unallocated accounts crisis that's brewing in London, because this is where millions of retail investors are at risk without even knowing it. Many people hold unallocated silver with LBMA member banks. This is essentially a bank account denominated in ounces of silver rather than dollars. You have a claim on a certain number of ounces, but you don't own specific bars with serial numbers. The bank pools all unallocated claims and operates on a fractional reserve basis. They only keep a fraction of the claimed ounces as physical inventory because historically, very few people demand actual delivery. This system works fine in normal times, but we're not in normal times. London is cut off from its main supplier, New York, while still facing massive delivery demands from Asia. If you're holding unallocated silver in a London bank, you're essentially holding an IOU from an institution that just lost its ability to source metal. When the market realizes London is besieged, I expect a massive run on unallocated accounts, investors frantically trying to convert their paper claims into allocated physical bars. But there aren't enough bars. The banks will be forced to go into the open market and bid for any metal they can find at any price. This is how a liquidity crisis becomes a solvency crisis. This is how banks that looked perfectly healthy on Friday can be in serious trouble by Wednesday. And this is why, if you hold unallocated silver anywhere, but especially in London, you need to be making phone calls first thing Monday morning to convert to allocated or close your position entirely. Let me address something important before we go further. There are copycat channels stealing this analysis, repackaging it, and presenting it as their own. We spend enormous amounts of time researching data, connecting dots, and providing analysis that you won't find anywhere else. If you value original research and you want to support the people actually doing the work, drop a comment right now saying, "Staying with the original," so the algorithm knows you're here for real analysis, not recycled content. Thank you. Now, let's talk about what this means for you practically. What should you be doing right now this Sunday evening to position yourself correctly for the chaos that's coming? First, if you own paper silver, SLV shares, silver futures, unallocated accounts, you need to make a hard decision tonight. Are you comfortable holding paper claims on a market that's fracturing? Are you comfortable owning a share of an ETF that stores its metal in London, which is now cut off from resupply? I'm not going to tell you what to do. I'm not a financial advisor, and this isn't financial advice, but I'll tell you what the risk-reward looks like. Paper silver might go up tomorrow. It might go up a lot. But it also carries the risk of redemption freezes, trading halts, forced cash settlements, and all the other nightmare scenarios that happen when logistics break. Physical silver in your possession carries none of those risks. It might be less liquid in the short term, but it's yours. It's real, and nobody can freeze your account or change the rules on you. Second, if you're looking to buy more silver, tomorrow might offer a weird window of opportunity. In the confusion and volatility of the Monday session, there might be moments where algorithms push the price down temporarily because they can't properly model what's happening. If you see a dip, if COMEX silver briefly drops below $90 while everyone's trying to figure out the new rules, that could be a gift. But don't wait for it. If you've been waiting for the right time to add to your position, the logistics breaking might be the catalyst that means there is no perfect entry coming. Third, understand that we're entering a new era, the era of regional pricing. For the last several decades, we've lived in a globalized world where the price of silver was essentially the same everywhere. Maybe small variations for shipping and premiums, but fundamentally one global market. That era is over. Going forward, silver will have different prices depending on where it physically sits. Metal inside the United States will trade at one price. Metal trapped in London will trade at a different price. Metal available in Shanghai will trade at yet another price. The spot price you see on financial websites will become increasingly meaningless because it's an average of multiple disconnected markets. This means you need to start thinking about your silver in terms of replacement cost, not spot price. If you own 100 ounces of physical silver in the US, the relevant question isn't, what's spot price today? The relevant question is, if I sold this, could I buy it back? What premium would I have to pay? How long would I have to wait? Those are the real metrics of value when markets fragment. Fourth, expect premiums on physical silver products to spike this week. We're already seeing premiums of 8 to 12 per ounce over spot for popular products like American Eagles. With the tariff adding 10% to any silver imported from Europe, dealers are going to have to raise prices to cover their increased replacement costs. I would not be surprised to see premiums hit $15, $20 by the end of the week, which means physical silver you can actually buy and hold will be trading at $105, $110, even if spot price is still showing $90. Fifth, the big picture. We are watching the balkanization of global financial markets in real time. The era of frictionless, borderless, globalized commodity trade is ending. We're returning to a world of walls, tariffs, export restrictions, and trapped assets. In this world, physical possession is everything. You don't want to own a contract for silver in London if London can't source metal. You don't want to own shares in an ETF that stores metal in a jurisdiction that might implement capital controls or export bans. You want the metal in your hand, in your country, under your control. The Roach Motel Effect, silver checks into the US but doesn't check out, is actually a massive advantage if you're a US-based physical holder. Your metal is in the most secure, most liquid, most protected market in the world. It's protected by the tariff wall from being exported to bail out foreign banks. It's available to US industry, which creates natural domestic demand. And it's in a jurisdiction where property rights are relatively secure and rule of law still functions. Let me give you the timeline for what I expect this week. Monday will be chaos. Big moves, confusion, volatility, as markets try to price in something they've never seen before. Tuesday and Wednesday, the reality will start setting in as London confirms it cannot source metal from New York, as Asian premiums continue climbing, as stories circulate about delivery delays and cash settlement offers. By Thursday and Friday, I expect we'll start seeing emergency measures, exchange announcements about margin requirements, bank statements about processing delays, perhaps even government intervention in some form. By the end of next week, the silver market will look fundamentally different than it did Friday. We'll have regional pricing, we'll have confirmed logistics disruption, we'll have proof that the paper market can't deliver, and we'll have a price that's significantly higher than $90, whether that's $100, $110, or more, depends on how quickly panic spreads and how aggressively banks try to cover their broken hedges. The Greenland tariff, which seems like a joke to the mainstream media, is actually one of the most significant events in precious metals markets in the last 50 years. It accidentally, or deliberately, destroyed the suppression mechanism that's kept silver prices artificially low. It severed the connection between the world's two largest trading hubs. It trapped strategic metal inside US borders. It exposed London's vulnerability. And it did all of this with a single sentence buried in a tweet about buying an island. Tomorrow morning, when markets open and prices start moving, most people won't understand why. They'll see volatility and think it's just another day in the silver market. But you know better. You understand that the logistics have broken, the arbitrage has failed, and the paper market's credibility is about to be tested like never before. Position accordingly. Protect yourself. And don't get shaken out by volatility that's designed to confuse you. If this analysis helped you understand what's really happening while everyone else is laughing about Greenland, hit that like button. Subscribe to this channel because we're going to be tracking every development as this historic week unfolds. And drop a comment telling me, are you holding physical paper or cash going into tomorrow's open? And what's your biggest concern about the week ahead? The bridge between London and New York has been destroyed, the global silver market has fragmented, and tomorrow the world is going to start discovering what that means. Don't say you weren't warned.